The Bank of Canada has raised its key rate for the second time in as many months. The half-a-point increase is the largest in more than 2 decades, and the central bank is warning rates will need to go higher than the current 1% to deal with soaring inflation. It's now forecasting inflation will average almost 6% in the first half of this year. That's up from its January prediction to close to 5%.
With an economy with considerable momentum, an economy that's moving into excess demand, our domestic inflationary pressures are also increasing. The other key reason to raise rates today and to signal the need for further increases is that we need to bring demand and supply back into balance and bring inflation back to target.
Joining us now to talk more about the impact on your finances is Allan Small, financial planner with Allan Small Financial Group, and Allison Vanrooijen, Meridian VP of Consumer Credit. Thank you both for being with us. Allison, this is the highest rate hike in 2 decades, but to be fair, interest rates still pretty low, right? How significant is this latest hike?
That's a great question. So you're absolutely right. It is a significant rate hike, considering we haven't had a rate hike like this in about 20 years. But in the grand scheme of things, a 50 basis point increase right now isn't what we should be primarily focused on. It's the fact that it's the second of many to come. And so consumers really should be looking at what their financial implications are as a result of multiple rate increases to come.
Right. So maybe it's time to look ahead and plan ahead. So, Allan, with that, we'll come to you. The cost of living, as we know, is going up. Food prices, gas prices through the roof, and interest rates, as Allison pointed out, are rising. So is it time to revisit the household budget?
I think so. I think, we're entering into a new environment now. We used to say lower for longer. Interest rates would remain lower for a longer period of time. Well, times have now changed and interest rates are on the rise, obviously rising as much as 75 basis points already and a lot more to come. So definitely looking at what you're spending in the household, how much have things gone higher, and what is affordable. A lot of individuals are borrowing money either on a line of credit or other ways, a mortgage, variable rate mortgage. These costs are now going to rise, and people need to be aware that these are going to continue to rise and start to make adjustments accordingly.
Right. It's all about that financial literacy. Allison, what do you say to people with variable rate mortgages? How should they expect their payments to change?
I completely echo Allan's comments. Now is the time to take a hard look at your personal budget if you're in a variable rate mortgage. Some lenders, your mortgage payment won't change month to month, but you'll have to play catch up by the time that term comes to an end. Other lenders, your payment may shift in the next month. So call your advisor or your mortgage broker, your credit union financial advisor, and look at the numbers both on your mortgage and any other debt you have, and really take a look at how your monthly household cash flow will change as a result of these rates.
Right. That is such good advice. Allan, this may also be a challenging next couple months for potential first-time home buyers who may need to set aside some extra cash. Any advice there?
Yeah, I think for anyone looking to buy a home, a new home buyer, I think you definitely want to take a look at what is offered at this point in time. Take a look at where fixed rates are and compare them to where variable rates are. We know that rates are going to move significantly higher for the remainder of this year. And then you could make a calculation with your mortgage broker to really figure out what is the best way, or which is the best way to go. Is it better to fix the rate at this point in time? Mm-hmm. And at least you don't have to worry going forward that interest rates may rise another 50 basis points or another 100 basis points. Or do you want to go variable and take that chance? Over the long term, variable rate still seems to win out. But I think for many people, especially during uncertain times, fixing their rate makes a lot of sense.
So, Allison, would you give that same advice to a potential first-time home buyers or anybody qualifying for a mortgage? Is it the fixed route? Is that the way to go?
Especially for a first-time home buyer, when you have all these additional household expenses, you're getting home insurance for the first time, you may have upgrades to make to your house. Work with a financial advisor or a mortgage specialist and understand what options are available. I would say the financial services space has really innovated in the past 4 or 5 years on programs specifically for first-time homebuyers to address the affordability issues. So there may be options available to you as a first-time homebuyer that you weren't aware of 4 or 5 years ago. So definitely reach out, and I would echo, understand your true after-tax cash flow numbers so you can make an informed decision.
Yeah, really important to look at all of the numbers, right? What about qualifying for a mortgage now? Does that get harder?
Absolutely. So, as a result of this rising rate increase, the qualifying rate for a B20 or a bank mortgage typically has been the higher of your contract rate plus 2% or a benchmark rate of 525. But now that fixed rate mortgages are typically going higher, we're surpassing that 5.25. So the interest rate a borrower will qualify on is only going to get higher, which can decrease the maximum mortgage someone can qualify for.
Okay. Allan, rising rates will impact consumers. They'll also impact businesses. What do you expect there? And what do you say to business owners?
Well, I think the business owners are definitely going to feel it quite a bit. Obviously, their bottom line will be affected. You know, how much money they take home will be affected. We know that demand is still very strong. The consumer is still spending a lot of money. So top line growth in these businesses remains strong. But it's the bottom line now. Expenses are definitely going up. When you combine the higher interest rates that these businesses will have to pay on their loans, you combine that with higher energy costs, higher labor costs, higher raw material costs in some cases, depending on the business. These businesses are definitely in tough going forward. And as interest rates rise, that only just adds to more expenses. So I think businesses, again, have to take a look at their business model. They have to prepare for what's coming down the pipeline. But overall, the economy is still very strong. And I believe that the markets and businesses can still do well in a rising interest rate environment. I just think you just need to plan for the future and be aware of what's happening around you.
Right. Allison, are the big banks expected to follow suit and raise prime rates? Any announcements tonight?
Yeah, so we've seen a few of the big five move already, and it's no surprise we expect others will follow suit. We're keeping a close eye. Sometimes they'll deviate a bit here or there, but overall we expect banks will be increasing that prime rate, which will then be passed along to borrowers through all forms of credit debt, whether it's a mortgage, a line of credit, a HELOC, as much as an automotive loan.
And Allan, what do you tell the retired people who are relying on a fixed income? What advice do you give them tonight?
Well, I think it's interesting because, sorry, I think
I will let both of you answer that. Allan, take it away first.
Okay. I think the retired folks, I think they're actually going to benefit the most from this. You know, for a long time, they've had to move into the stock market and really invest in the stock market to try and grow their money and their wealth. As interest rates begin to rise or continue to rise, I think what you're going to see is now these retirees that were forced to take a position in the stock market to grow their wealth, at some point interest rates will move high enough that they can actually go back to buying traditional GICs or bonds to actually make a pretty good or a decent rate of return, interest payments coming in to at least keep up with inflation and maybe even at some point surpass inflation. So I think the retiree is going to be a little bit, I guess, happier than everybody else right now because they'll be able to invest their money into higher interest paying investments, which is what they want, which is what they wanted for some time, but unfortunately could never do it because interest rates were so low.
Hey, at least somebody's winning. Allison?
Just to add to that good news, I think we saw through the pandemic a vast majority of Canadians were able to pay down their non-mortgage debt as they sat on some extra cash. So that was great news that prepared us in anticipation of these rate increases. So those on a fixed income, if they've been able to address that non-mortgage debt, that was a great behavior and should continue. And for those that haven't paid down that non-mortgage debt, now's the time to have a great conversation on that budget about what additional cash flow is available or what tools might be able to help with some of those variable costs.
Okay, Allison and Allan, excellent advice tonight. So appreciate it. Thanks so much for joining us.
Thank you.